Hello everyone, welcome back to the Adkup Show. Today we are tackling a massive story that's been making waves in India and beyond. Is India's grand vision to become a global manufacturing powerhouse starting to crumble? You have heard the buzzwords Make in India and the $23 billion Production Linked Incentive Scheme or PLI. The promise with that scheme was to create millions of jobs, booming exports, and a seat at the table with giants like China. But here's the harsh truth. Manufacturing share of India's GDP has slipped to 14.3% in 2023 to 2024. Exports are stuttering and big investors are turning their backs. So the question is, what's going wrong? And why can't India seem to get this right? In this video, we are diving deep into three critical questions. Why is the PLI scheme hitting a wall? Why is manufacturing in India on the decline? And why are investors hesitant to pour money into Indian factories? So without wasting time, let's get started. Let's kick things off with the Production Linked Incentive Scheme, PLI for short. Prime Minister Narendra Modi's government is not planning to extend its flagship Production Linked Incentive Scheme beyond its current timeline. Now, this is not 100% confirmed, but according to many reports, it looks like the government is not able to deliver what it promised through PLI. Launched in 2020-2021 with an outlay of about $23 billion, which is a big amount if you convert that to purchasing power parity. The program aims to boost domestic manufacturing and attract global investments. Launched in March 2020 with a core budget of about $23 billion, PLI was India's big bet to turbocharge manufacturing. The pitch was simple: give companies financial incentives based on extra sales of goods made in India. It started with three sectors: mobile phone, electronic components, and medical devices. And then it was extended to 14 sectors by 2021, covering everything from automobiles and solar panels to textile, drones, and specialty steel. The Modi government sold it as a game changer. It was to attract global heavyweights, slash import reliance, and create millions of jobs. And in some ways, it delivered. Take mobile phone manufacturing as an example. It's a poster child of PLI's success. Back in financial year 2017-2018, India imported 3.6 billion worth of mobile phones. By financial year 2022-2023, that was down to $1.6 billion. Phone exports skyrocketed from $334 million to $11 billion, hitting $15.6 billion in financial year 2024, a jaw-dropping 42% jump year on year. Apple was a big winner here. 94% of India's smartphone exports came from them and Samsung. By the way, in 2018, Samsung inaugurated the world's largest mobile manufacturing facility in Noida, India, in presence of Indian Prime Minister and South Korean President. So not everything is going in a wrong direction. India's manufacturing is actually getting better. Foxconn's plants in Tamil Nadu are churning out iPhones, giving India a $9.8 billion export surplus. Pharmaceuticals also crushed it. Exports nearly doubled to $27.85 billion in financial year 2024, thanks to PLI boosting local production of drugs ingredients like APIs. India has the reputation of producing the cheapest and affordable pharmaceuticals in the world at an industrial scale. But here's where the wheel starts wobbling. A March 21, 2025 article from Outlook Business dropped a bombshell. The government might not extend PLI beyond its current 14 sectors or timelines, even though corporations are clamoring for more. So the question is, why government is pulling that back now? Well, the overall data is grim. By October 2024, PLI firms produced $151.93 billion worth of goods. That's solid, but that's only 37% of the government's target, which works out to roughly $410 billion over 5 years. Worst part of that $23 billion budget is that just $1.73 billion is used as of now since its start in 2020-2021. That's less than 8%. That's a mountain of cash sitting idle. If we dig into the sectors, the cracks will widen. Electronics and pharma are shining stars, but others not so much. A December 2024 Renewable Energy Ministry report flagged that 8 of 12 solar PLI schemes like Reliance, Adani, and JSW are on track to miss their target by 50% by financial year 2027. This is because solar needs massive upfront investments and tech India doesn't fully have yet, like lithium for battery or polysilicon for panels. Specialty steel is also a mess. 14 out of 58 approved projects were abandoned because they couldn't get off the ground. Textile, auto components, drones, even advanced chemistry cells batteries, all lagging. The companies aren't able to reach their target on time. So the question is, what's driving this shift? In order to understand that, we need to break down the PLI scheme. First, uneven success. PLI worked where global supply chains were already shifting, like mobile phones with Apple and Samsung, but flopped in sectors needing deep local ecosystems. Second is bureaucracy, which is turning out to be a killer for India's manufacturing aspirations. Companies hitting targets still wait months for payout. Third is fiscal pressure. With India's fiscal deficit at 5.6% of GDP in financial year 2024 and post-COVID recovery still shaky, why sink billions into underperformers? That money could be invested into something else where returns are guaranteed. Fourth is strategic pivot. Routers hint the government's eyeing alternatives like reimbursing factory setup costs instead of tying incentives to output. That's less risky and faster to roll out. Minister of State for Commerce Jitin Prasada gave the latest figure in November 2024. 764 applications approved across 14 sectors, $17.99 billion invested, $158.53 billion in production, over 1.1 million jobs created, and $59.26 billion in exports. Now that's not bad, but if we stack that against the hype which was of millions more jobs, $520 billion in exports over 5 years, then we will find out that it's underwhelming. PLI is not dead, it's evolving, so as India's manufacturing. The government's tweaking it, maybe focusing on winners like electronics instead of propping up losers like steel, which shouldn't be in a loser category because it's a very basic and important commodity. But overall, it's a far cry from the ground vision. Now let's zoom out. The PLI struggles are just one piece of bigger puzzle. Manufacturing in India is declining, and it's been a slow bleed. Back in 2017-18, it hit a high of 18.4% of GDP. By 2023-2024, it's down to 14.3% as per economic survey. The Make in India target was of 25% by 2025. India is nowhere close to that figure. Jobs are worse. Manufacturing employs just 11.6% of the workforce, about 63 million people in 2021-2022, down from 12.6% a decade ago. Meanwhile, agriculture's share jumped from 42% in 2017-18 to 48% in 2021-2022. That's not growth. That's workers retreating to farms because factories can't deliver. So why is this happening? Let's unpack it. First, costs are brutal. Industrial power in India is 7 to 10 rupees per kilowatt an hour. In Vietnam, it's 4 to 5 rupees. And in China also, it's cheaper than India. Logistics are 14% of GDP, while 8 to 10% in China or 9% in Vietnam. Fuel taxes over 100% means shipping goods from Tamil Nadu to Delhi can cost more than from Shanghai to Mumbai. Yeah, that's true. That's $2,000 versus $1,500 as per a 2023 Economic Times report. Infrastructure is a nightmare. Roads are potholed, ports like JNPT hit 90% capacity, and power cuts are common. In Coimbatore, textile units run at 50% capacity for 8 months in 2024 due to shortages. Second, regulations choke progress. GST streamlined taxes, but manufacturers still wrestle with 44 labor laws, environmental clearances, and land acquisition rules. For anything to get cleared, manufacturers have to pay a big bribe. The Factories Act mandates safety but drowns firm in paperwork. Policy is shaky too. PLI's payout delay and visa blocks for Chinese technicians stall projects. India ranks 63rd on World Bank's Ease of Doing Business Index. Vietnam is at 70th, but it's simplicity that wins. Basically, Vietnam also has many rules and regulations, but they take technocratic approach and everything is cleared on time. While in India, it's bureaucratic approach which delays everything because the nature of delivering is very slow. Government can't push it beyond a line because that might hurt them during the elections. India has a low-performing, lazy, and corrupt bureaucracy where things stops to move after a certain point. Third, productivity is flat-leaning. Only 5% of India's workforce has formal vocational training, while East Asia is at 60 to 90%. R&D spending is also very low. It's only 0.64% of the GDP in 2023 versus China's 2.3% or US's 3.4%. India's factories lean on 20 years old tech while competitors roll out robots and IoT. Productivity growth's been slowing since the 90s. Pre-COVID, it was 2 to 3% annually, now barely 1% as per RBI data. Then there is imports. $250 billion trade deficit in financial year 2022-2023, with China dumping cheap steel and electronics in India. By the way, in the US, 87% of R&D is done by private institutions. In China, it's 80%, and in India, it's only 30%. 70% of R&D in India is done by government, which is just laughable because nothing really goes into R&D. The majority of that 70% goes into paying salaries and other miscellaneous expenses. India needs to take technocratic approach in this rather than hanging with slow and failed bureaucratic approach. The government needs to tell the country's billionaire to increase their share in R&D. Fourth is shocks and demands. Demonetization in 2016 wiped out cash-based small firms. Cement production, a manufacturing proxy, crashed 16% in February 2016. GST in 2017 shifted demand to big players but shrank the sector overall. 80% of manufacturing is informal and they are still reeling. Also, COVID's two waves crushed output. Industrial production fell 11.5% in financial year 2021 and demand is also very weak. Private consumption is down by 2% in real terms since 2019. Put it together, high costs, red tape, low skills, and battered base. India's missing the structural shift which China nailed decades ago. That's why manufacturing in India is fading and investors are taking notice of it. India's got 1 billion plus consumers, wages at $2 to $3 a day, and Modi's pitch as the next big thing. So why aren't investors rushing in? First, returns are dismal. McKinsey's 2020 report found 700 of India's top 1,000 manufacturers in 2018 had returns below their cost of capital. Think about steel or solar. PLI lured $21.34 billion in FDI in financial year 2022, a 76% jump, but it's mostly private equity, not brick and mortar bets. And by 2024, FDI inflows dropped 43%. Second, it's roller coaster. Bureaucracy's a nightmare. Land approvals take 6 to 12 months. Environmental nodes take another year. PLI's $1.73 billion payout by October 2024, which is only 8% of $23 billion, shows delay kills momentum. Policy is erratic. 2024 visa curbs on Chinese exports stalled $2 billion in electronic projects. High tariffs clash with exports goals, scaring off globals like Toyota. Investors crave predictability, but in India, it's all chaos. Third, operations are a slog. Outage forces diesel generators hiking costs 20 to 30%. Logistics are very high. It costs $2,000 to ship Chennai to Delhi versus $1,200 Shanghai to LA, as per Fair Observer 2023. Supply chain is also a big mess. 90% of manufacturing is SMEs, tiny, scattered, and with no scale. China's got Shenzhen, Vietnam's got SEZs, India's got bottlenecks. Fourth, rivals are winning. Vietnam's FDI soared 32% while India's tanked. Why did that happen? Well, electricity is cheaper, rules are simpler, projects launch in months. Samsung is 60% of Vietnam's phone exports now. China's $2 trillion manufacturing GDP dwarfs India's $450 billion. Its ecosystem is unmatched. ASEAN trade blocs like RCEP gives Indonesia and Thailand an edge that India skips. Money follows efficiency. However, RCEP has its own drawbacks. This agreement has benefited mostly China and has destroyed domestic industries of ASEAN countries. So, low returns, unpredictability, tough operations, better options, bad vibes. Investors aren't sold. So where is India? PLI is not working well as planned. It boosted mobiles and pharma, but it's no silver bullet. Manufacturing is declining. Costs, infrastructure, and policies are anchors. Investors see potential but not profits. Services like IT and finance carry India's GDP growth, but not factories. The dream of becoming a manufacturing powerhouse is fading, but can India save it? Well, fixing this isn't cheap or quick. Infrastructure, $500 billion for roads, ports, power is a start. But India needs more skills. 5% trained won't cut it. Aim for 50% with vocational hubs. Slash 44 labor laws to 4. Fast track approvals. R&D needs to be triple spending to 2% of the GDP. Cut taxes to boost spending, not hoarding. PLI's pivot to set up costs could lure investments without output gambles, but it's banded without a big fixes. Time is short. Vietnam is snagging China's +1 deals. $36 billion FDI in 2024. China's not slowing, $2 trillion and counting. India's $450 billion manufacturing GDP needs a rocket, not a nudge. Without action, India is just a service economy with factory footnote. So, what's your take? Can India pull this off, or is India too late now? Drop your thoughts. If this deep dive hit the spot, smash that like button, subscribe, and ring the bell. We are breaking down big stories like this all the time. Thanks for watching. See you next time. Peace out.